What's up, everyone? It's Scotty with Money Vesting. Welcome on board for another Market Open live stream. We've got 17 minutes till CPI, Consumer Price Index, for the month of February is going to be coming out. We're going to take a look at the market's reaction. We'll see how the bond markets are doing. We'll take a look at the volatility. We'll take a look at the crypto market. There's a lot to unpack, so I hope you all are doing great this fine morning. And again, the poll is open. Make sure that you do vote considering what your expectations are for CPI going into this print. Futures right now, we are green, so QQQ is very green, pushing up 82 basis points. We're getting the SPY up over 90 basis points, and the Dow Jones also rallying. I did a video on one ETF to watch yesterday on both non-levered and levered basis. XLF was one of them. It's up 2.85%, so getting that oversold bounce back higher. And we also talked about FAS pushing up over 8%, considering that the government's kind of backstopping a little bit, and we're seeing that confidence restore among bank stocks. So we are seeing a little bit of a push right back up. Put the timer on. So I actually have a new sort of template. So I don't have the timer on this one because I've changed the camera and I've changed the screen and everything. So unfortunately, I don't have that, but I will be kind of constantly letting you guys know when that next CPI report is coming out. And in about 5 minutes, 10 minutes or so, I will be doing an audio check just to make sure everything's working well. And then we'll go over to BLS.gov to see what that report's going to look like. And of course, talk about are we declining, going higher, and of course, year over year, month over month, and the market's reaction to that as well. So welcome on board, everybody. Big day. So this is really what's going to dictate, right, whether the Federal Reserve actually goes 25 or 0. Because earlier, up until last week, there was a debate between 25 and 50. By the way, I posted a video about that. And this has been a huge shift in the overall sentiment. And of course, the Fed Funds Future is getting a big shift of 125 basis points in a matter of 6 days. And yet the market's not able to find any momentum back higher, despite what we're seeing with the Fed Funds Futures. I also break down the S&P 500's valuation on an aggregate basis, considering the fourth quarter earnings. And I also talk a little bit about the interest rates and the expectation with terms of recession in the economy as well, going over the earnings calls for the fourth quarter 2022 from a lot of companies in the S&P 500. So make sure that you do check that out as well. So Vince says FRC calls, man, it's already pushed up. First Republic Bank is already pushed up quite a bit. Unfortunately, it's already at 43, 48%, right? So it's a bit of a dead cat bounce. I was more in line with XLF and FAS. I was looking at these two ETFs from a more risk-adjusted standpoint. I mean, FAS was definitely on my watch list. Even, again, talked about it, did a video on this yesterday during the day. It's already gapping up here, 8.5%. So definitely seeing a lot of momentum back higher. Because if you think about it logically, right, if you think about what really transpired in the last 48, 72 hours, once the government stepped in, and backstopped all deposits, right? So pretty much making sure that insurance is available, unlimited insurance available to all depositors. That really restores confidence. And yes, we're going to see that fear kind of ripple through a little bit into Monday, which was yesterday. But once you've got that deposit base still intact, once you've got that stability, that confidence, and the reason why I was more inclined towards XLF and FAS, does anyone want to take a stab at this? I'm going to ask you a question. Why I was a little bit more inclined towards XLF a little bit than compared to KRE. Well, I've given away the answer, but it's more towards the composition or the weightings of these ETFs. XLF's more made up of larger banks. So even if companies and CEOs and founders and venture-backed firms, they decide to pull deposits out of the regional banks, where are they going to go, right? They're going to go to U.S. Treasuries. We've already got a hedge on U.S. Treasuries. We've already got that covered with TMF. But the other side of the story is SIBs, right? Systemically important banks. And we're talking the big four, JP Morgan, Bank of America, Wells Fargo, like some of the bigger banks here. And that is where XLF and FAS comes into play. So their deposit base is going to grow, and they're going to be able to lend more money. They're going to be able to invest more money. Their reserve capital requirements much higher compared to regional banks, which is literally nothing, because they're doing over $110 million in transactions. So that's why it's two opportunities on how you can actually play this. Was, of course, TMF, because we saw the U.S. Treasuries pretty much get collapsed here this past week, dropped from like 4% to 3.5%, and another one was XLF or FAS, already starting to push back higher. So Bass, Caddy, let me take a second to just thank you for covering these items and doing live streams nearly daily to give us such valuable information. So Bass, thank you so much. I really appreciate your comment. Really appreciate it. So Vin says FRC calls. I got FRC at 23, could go to $90, Caddy, up to $90. That's incredible. I mean, yeah, FRC is definitely getting a lot of momentum back up, and right now it's at 46.73. $23, definitely a very, very solid entry. You're already up a little bit over 100%. Take a look at that volatility, right? From lows of yesterday of $17. It's already moved up 169%. Just insane amount of volatility for First Republic Bank. Even Charles Schwab is pushing higher, a little bit over, I think over 12 or 15%, 11%, 11.5%. And from lows of yesterday from 44.49, 28% rally back up. So we're seeing a lot of momentum. And I've actually added a lot of banks on our watch list here, which were down quite a bit. So this right here is another bank, which was Western Alliance. It's up 35% pre-market. And from lows of yesterday, it's already up a 382%. 382% from yesterday's low for WAL, Western Alliance. Absolutely ridiculous. Crazy amount of buyers stepping in. DPSD, this is another one that I'm actually looking into, but this is regional banks bullish levered ETF. Very, very risky, so make sure that you're doing your due diligence on that. But this is more of a regional bank. It's kind of following KRE. KRE is your regional bank ETF. It's up 8.5% right now because regional banks are also getting a lot of momentum back up. And DPSD is literally KRE, but on leverage here 3 times. So it's pushing up over 20% right now. Comerica 14.6. We've got Trust Financial up 9%. We've got regional banks ETF up almost 9%. We've got Fifth Third Bank Corp up 10%. Charles Schwab we went over earlier. Ally Bank is up over 3.6. So not a lot, not as much as some of the other ones. And that's considering because they also do have about $4 to $5 billion in bonds that are underwater right now. And they're in a very similar situation in Silicon Valley. So something to keep in mind for that as well. And then of course we got another bigger bank, Citi and Bank of America. They're also higher, 2 to 3%, 4% for Bank of America. Credit Suisse is in a difficult situation. This is the only bank they actually reported their earnings, and they reported some of the other estimates and really what the position is right now. It's kind of like a delayed report, annual report that they were supposed to release, and that came in, but not super strong for Credit Suisse. So they're slightly down, close to 2% right now. Anyway, so we do have the poll open, so make sure that you do vote if you haven't already. Caddy TMF is going down, more downside. So it really depends on the yields, right? So yields are starting to rotate back higher, up to 3.6%. But my goal eventually was to build out a sizable position. So even if it does come down, even if yields continue to push higher, I am going to be interested in kind of building that position out because I'm expecting more on the intermediate to longer term for yields to rotate back lower eventually, right? This was never supposed to be a quick trade. Otherwise, I would have taken profits, right, when the yields dipped below 3.4%. So I've been adding a little bit on the way up, but as yields continue to maybe drop a little bit further, then I'll set up some profit targets for myself. But of course, if you want to trade, $10 was that profit target area, and definitely have your stop losses in place if you are trading it. But me personally, this was never supposed to be like a quick trade. I'm expecting yields to roll over even further in the future. Yes, we went over Charles Schwab, we went over First Republic. We just went over like a quick summary of all the banks here, but we've also got inflation coming out in now under 8 minutes. So I think that's going to be more important, even though that's been kind of sidelined a little bit, right, over the last few days. We haven't really seen any inflation headlines, right? We haven't really seen anybody talk about CPI or inflation, or we haven't really seen anybody talk about anything other than Silicon Valley Bank or the financial sector, right? That's how much it's kind of been front and center in our lives over the last 4 to 5 days. But rightly so, because it is the second largest bank failure in U.S. history. It's the 16th largest bank, and definitely going down, taking down a lot of companies with it. All right, so right now we've got 46% of participants expecting the CPI to be between 6 and 6.4%. The second best coming in at 26%, above 6.4%, and then we're kind of tied for at 6.4% and below 6%. So definitely going into this print, the expectations are a little bit more on the neutral / bearish side. Certainly not bullish, not expecting below 6%. So let's just go over some of the expectations. By the way, this is a private video I posted 7 hours ago for all the members to watch. Definitely do check that out. We're going to be starting our wheel strategy and our TIBA ladder strategy starting in April 2023. Ladder we might pick up later in the year, but wheel strategy we are going to be starting with options later in April, and the ladder we're going to build sometime maybe around May, June, maybe a little bit higher. But I just gave you an example of what that's going to look like if you were to start over the next 6 months. But this again is going to be some of the expectations: bear case, bull case, base case, and optimistic. These are the expectations. I love how Jonathan Farrow from Bloomberg goes CPI guesses year over year, not expectations or not estimates, guesses for a lot of these banks on a year-over-year basis. So ING 6.2%, BNP Paribas 6.2%, BofA 6.1%, Citi 6.1%, TD 6.1%. So not a single bank is expecting a CPI to come in at over 6.3%. The highest we're going up to is 6.2%. Now imagine for a second if CPI comes in at over 6.3 or 6.4. Markets are going to be absolutely toast if that ends up happening. It would be crazy if we actually see CPI at above 6.3, 6.4, because that's going to crush expectations. Year over year right now, we're expecting 6%. That's the consensus. And this is from the banks. Again, everybody's mostly expecting 6% for the most part. So anything above 6.2, and it's going to rain. It's going to rain a lot of bears for the market. This is going to be from the Cleveland Fed. February numbers expecting 0.5% month over month, and year over year expecting 6.2. So 6.21 to be precise, 6.2 rounding down, 6.2 from the banks, and 6 on the median basis, and 6% on econ day, which is the consensus. So, yeah. Better be ready. Better be ready. CPI to 5.9%, I'm Coffee says. Bass says it's going to be 6.2. So we're already starting to see a little bit of a disagreement there. So the Fed cuts now in consideration. So right now we are pegged for a couple more hikes. At least that's what the Fed Funds Future is pointing to. But I'll keep a close eye on the Fed Funds Futures here just to make sure that what the market's reaction is with respect to how we pivot after the numbers come out. And right now as it stands, last time I checked, it was a 75% probability. So right now it's 74% probability that we're going to see a 25 basis point hike going into this print. We'll find out in under 4 minutes. I'll do a quick check on Bloomberg here just to make sure that the audio is good. Just give me a thumbs up and we'll make sure that it's working. So let me know. Just give me a thumbs up here.
American people have confidence in their financial system. We have politicians dancing around in a hackish way, trying to drive their own agenda. We have folks that are opining so that they can actually have a greater platform. And what we see is people trying to dine on the bones of America, and I think that's highly irresponsible. At a moment like this, we should understand what these agencies do. The Fed is doing what the Fed is supposed to do.
All right, perfect. The audio is good. We've got about 3 minutes. I'm going to quickly switch over to the QQQs here. We're going to put the SPY over here. And I'm going to have the 10-year yields right over here, just behind my face at the bottom left. And we'll put the dollar index over here. We'll see how it trades, although it's going to be covered a little bit from the screen. So Raj, yes, I did close out my Tesla covered calls on Tesla. I had covered calls, 3 of them. Yes, I did close them out for about a 94% profit because we were expecting downside on Tesla, and Tesla continued to drop. In fact, dropped down to as low as 164, but I did close them out when it got down to like 174 or 175, around those levels. So those calls were pretty much worthless, so I did buy them back for next to nothing. So, but yeah, Australia, I totally understand the time zone difference is brutal. I totally get it. So, but yeah, I mean, we'd love to have you on board, so the link's going to be down below if you're interested. Anyway, let's just go right in. Got 2 minutes. 2 minutes. Make sure that you vote. Vote, vote, vote. We've got 256 votes. We can definitely get up to at least 300 before the numbers come out. So let us know what you think. But right now, 6 to 6.4% is where the probability is right now. Mohammed says it's 327 here in Kuwait. Man, that's crazy. Is it really? But it's got to be in the afternoon, right? No? Yeah, no. I don't know. Isn't it the afternoon? It's not late at night. All right, so I'm going to reload that page in about a minute 30. This right here is going to be that page. We're going to see the first thing we're going to look at is the CPI for all items rises or falls or stays flat, whatever that number is in February, and then whatever that reasoning is, and we'll open up that PDF while listening in on what they have to say. So I'm going to shut myself up now. 1 minute left. We're going to listen to CNBC, and we should be all set.
earthbreeze.com.
Welcome back to Squawk Box. It is time for the big number, February CPI. I want to get right over to Rick Santelli. Rick.
Yes, of course, we are expecting our February read on the Consumer Price Index headline number, expected to be up 0.4, delivers exactly up 0.4. High watermark here was up 1.3 in June of 22, and that was the highest since 2005. Strip out the all-important food and energy, up 0.5%. This is 1/10 hotter than we were looking for, and it's 1/10 hotter than the rear view mirror. High watermark here, up 0.8 in April of 21. That went back to 1981. If we look at year-over-year numbers on headline, expecting up 6%, exactly 6%, and that is well off the 6.4 in the rear view mirror. High watermark 1981. In 1981, it was up 9.1, and that was a 40-year high. If we look at food and energy year over year, up 5.5 as expected, 1/10 lighter than the rear view mirror at 5.6. High watermark here at a percentage, 6.6. That was in September of 22. That went back to 1982. If you look at interest rates, they have moved a bit lower. You look at pre-opening Dow futures, they are going a bit higher. The only fly in the ointment here was the month over month being 1/10 hotter on core. But I think what most people were really paying attention to, Becky, was the year over year core at 5.5. That is indeed good news. When was the last time we had a 5.5? Let's go down the Wayback Machine. To find a smaller number would be November of 21. November of 21 to be smaller than 5.6. And on the 6.4, of course, we know that that's a little bit hotter than we were expecting in the rearview mirror last time. So to get it down to 6%, that was the lightest going all the way back to September of last year as well. Just by looking at the markets, this isn't going to move huge amounts in the interest rates because it's close to expectations, definitely coming off. One could argue the same argument, maybe not coming off as fast, but I'm very impressed with the year-over-year numbers. Back to you, Becky.
All right, Rick, stay right there. We want to bring in the rest of our panel. Joe Lavorgna joins us on set. He's a former economic advisor in the Trump administration and national economic chief economist. He's now SMBC Nikko Securities America chief economist. Dana Peterson, who is chief economist with the Conference Board. Jason Trennert, who is Strategas Research Partners chairman and CEO, and Steve Leisman. And Steve, why don't you just walk me through, first of all, and tell me what this means from the Fed's perspective? Does this make it more likely, or at least take the pressure off them to raise at this next meeting next week? You think they'll have the ability to sit back and say, we're going to take a pause because inflation's not hotter than expected, and we are concerned about what's happening in the financial system?
I think what the Fed's going to do is roll back Rick Santelli's reporting on the prior two inflation reports, both of which were hotter than expected. And they're going to look and see a nice, calm Rick Santelli today when they see it, and they're going to say, well, at least it wasn't worse than expected. They have a lot of work to do here. They've still got an inflation problem. But I think they'll feel like they have at least some wiggle room in that it was not worse than expected. There's one thing I'm a little, I guess, concerned about here. We'll see what to do with that. But I want to double check my number here. I do see that used cars and trucks, the prices were actually down 2.8%. And there's no other way to follow this issue here than listen to Phil LeBeau, who says that number is rising. So I'm a little concerned that this number did not pick up what's really happening in the economy. Sometimes that happens with a lag with the CPI number. I also noticed, Becky, that your shelter costs, OER, is still at 0.7%. It's a very important expectation at the Fed that this number comes down. It's about a third of the CPI, and it will hopefully come down, and that will be a big part of why the Fed can relax a little bit. I think this number, Becky, just to sum up, because it is not worse than expected, the Fed has the latitude or flexibility to pause if it feels it needs to because of the financial conditions.
All right, we'll come back to shelter in just a moment, but Joe, let's talk about what you think the Fed should do here.
They should definitely pause when you have a crisis like this, and you could just see based on market price action, how much the 2-year notes moved, biggest since '87, how much front-end spreads have moved, biggest since the Greek crisis. The Fed's either eased shortly thereafter, or they've paused. In this case, they could pause. They could stop the QT because the QT is draining the bank reserves at a 10, 11% rate. That's because right now what's happening is these smaller, medium-sized banks are scrambling for deposits. Wait, see how things evolve. You've got the new forecast. You can still highlight the fact they need to do more. They'll likely need to do more, but just wait. Go 5 weeks, see what happens. You can reevaluate in May.
Dana, how about you?
I think there definitely is a possibility that the Fed will pause next week. This is a crisis in the banking sector, and certainly the Fed doesn't want to do anything to exacerbate it. But I think that even if the Fed does pause next week, they should send a very strong signal that it's not done, that there still needs to be further interest rate hikes to tackle inflation. Inflation is sticky, and it's not coming down as fast as what would be expected.
Jason, if that is what the Fed actually does, and Steve Leeson has been telling us that that could be what they do, that they could take a page from what we saw in Europe last time around, where they stopped and then came right back on with the Bank of England. If that's the message, as an investor, what do you do? As somebody who's actually putting money to work, is that a sign for risk on again?
Not for very long. I think I would view it as kind of the pause that refreshes, and I would use it as an opportunity to probably de-risk the portfolio, because I agree with the other guests, and I agree with Steve and Rick. I think that there's a decent chance they pause tomorrow, but we're a long way away from the Fed's target. And I also think the Fed is also, we have to remember, is playing a political game here because we're heading into an election year next year. And I don't think they want to have their fingerprints over another bank failure. So there's a lot of things that are coming into play here. And it seems to me that as an investor, you want to de-risk the portfolios because we are getting to the point at which the Fed tightenings are breaking things, as they always do. And it will be hard, it seems to me, to avoid a recession given the amount of tightening that's been in the system. But it probably, discretion is probably the better part of valor here for the Fed, and they should probably take a little bit of a breather.
Jace, when you say de-risk the portfolio, I assume you mean don't buy financials even at discounted prices? Is that the case? What else would you mean by that?
I think so. I also think that there's still a lot of there's still a lot of companies that are either profitless or trading at very high multiples that are inconsistent with a Fed funds rate of 4.75 and an inflation rate, frankly, at 6. And I would say what the Fed has done this week, or at least what the Fed and the FDIC have done, you'd have to say is at the margin an easing. It's not a tightening I mean, it's necessary, but it's somewhat inconsistent with fighting inflation over the longer term. And that means the Fed is probably going to have to be back at some point later in the year.
Mike Wilson has been raising some concerns about this. Look, people had been thinking maybe he got it wrong until we saw things start to shake up like this. But you've still got the S&P at 3855 is where it closed yesterday, below 4,000, but still sort of hanging in there. It sounds to me, Jason, like you're just kind of uncomfortable with stocks at these levels still.
Yeah, I mean, I think Becky, at 18 times earnings, again, it's really hard to square that with a 6% inflation rate, even though it might be closer to 4 towards the end of the year. Just historically, that's a very hard thing to make the case for. And generally speaking, Randy Quarles has talked about the idea that the soft landing is really for fairy tales. That's something that it's happened. 1994 is a good example, but it's rare to have this kind of tightening without economic dislocation.
Joe, let's go back to just how concerned you are about inflation right now, how sticky you think this is.
If you have a recession, I mean, Jason admitted it, that you have an index leading indicator shrinking 6% annualized. But by the way, before the last week's situation, 2-10 curve, record inversion, minus 110, minus 111. I mean, that was 2 days before. So the Fed is now tightening and taking liquidity out of the financial markets and the economy. I mean, this is like silliness. I mean, they're making I think this is just pure stupidity.
But you think the inversion is a good indicator?
It's a great indicator because not only predicts recessions, it causes recessions. That's why the banks are scrambling for funding. So.
All right, everyone. So just miss on core. Month over month came in 0.5% versus 0.4. That was the expectation. Everything else was this nice meeting expectations, coming down year over year down to 6%. So in line with what the expectations were. And a majority of that decline coming in from used car prices and fuel oil. Fuel oil was a big decline here, 7.9% month over month. And used cars declining 2.8%. However, shelter prices are super stubborn. They were still up 0.8% on a month over month basis. Year over year, they're now up 8.1%. I can kind of show you this chart here that I was looking at earlier. So first of all items really seeing that big decline here. So you can see that we peaked back in June of 9.1%. Consistently coming down. So this is good disinflation that we're seeing February 2023. One more thing that I want to point out that I was looking at earlier, that as you can see that from September all the way till March and even call it April, we saw inflation pretty much going higher. This is 2021 all the way through 2022. So year over year comps were not as bad as unfortunately what they're going to be in the second half of this year. Because if you take a look at May, June year-over-year comp is going to be the toughest one, July. And even if you take a look at the month-over-month changes here, look at how high April, May, June were, right, last year. So month-over-month that, and then year-over-year, we're also competing with those comparables at 8.6, 9.1% on a year-over-year basis. So it is possible that, yes, we're seeing a pretty good disinflation. We're coming down on the back of two things. Number one, energy. Take a look at energy. June, it's come down from 41.6% all the way down to 5.2 now. Year over year, we're only up 5.2%. That's a pretty substantial amount of decline here. We talked about, crude oil prices declining, kind of consolidating sideways. And then if you take a look at vehicles, they've come down from 13.2. This includes, used vehicles, new vehicles, and down to now stabilizing a little bit at 5.8. So both have dropped, crude oil and vehicles, from double digits down to like a little bit over 5%. Those are good things. However, if you take a look at food, still not really. I mean, it's still coming down. It's come down from like 11.4 down to 9.5, but we're not seeing a pretty significant downtrend. It's still pretty elevated. You guys can kind of vouch for that. Let me know what grocery costs are in the US now. Are you paying more or less compared to last month? But food prices, as stabilizing as they are, they're not coming down. And then the big thing is going to be shelter. Just take a look at that linear growth. Just straight up pushing higher. It went from 7.9 to now 8.1% on a year-over-year basis. So we're still on the way up. Now, this big question after the print is, of course, whether the Federal Reserve is going to pause or hike. We've got a poll going on now. So make sure that you do vote considering what your expectations are. But right now, the market's still pricing in 77% probability, although it may take a few minutes for this to update. It usually does. So I'm going to continue to reload this. And after today's print, I wouldn't be surprised if the market's once again anticipating no hikes from the Federal Reserve on March 22nd, which is going to be next week. So the dollar index came down. It was kind of very, very volatile. So, you'll notice that we kind of popped a little bit up to 103.9, dropped back down to 103.7. The markets here gave up on some of the games. On a net basis, we are down pre-report than we are after, but still up 71 basis points, and the S&P is also pushing up 69, and the 10-year yields are pretty flat at 3.5%, but the VIX coming down pretty aggressively, down about 5.7%. So overall, it's a good report, right? Exactly what the market wanted to see, considering what we have going on in the macro landscape at the moment on the backdrop with Silicon Valley Bank and everything else. But again, the real question now becomes whether the Federal Reserve pauses or hikes. I'm not advocating for a higher interest rate, but I do still think that the Federal Reserve is going to go ahead with a 25 basis point hike, even after the report that we got. So 0.4% month over month, that was a consensus on point. 6% expected, 6% we got. 5.5% on core, which is a pretty important number. We also got that. Let's kind of take a look at the core CPI as well. And you can see how it has been coming lower. It had kind of like a double top from back in March and then September, 6.6, 6.5%. And then so far, we've been kind of seeing a consistent decline here from 5.7, 5.6, 5.5. So 0.1%, we're kind of rolling over little by little for core CPI as well. So overall, I would say pretty good report, but shelter prices are not caving, which I guess you can find the silver lining there. It's that if we are dropping without shelter, imagine what would happen if shelter prices were to really start to come off, considering that they also have a lag behind them, right? There's a pretty significant lag with shelter prices. If rents start rolling over, we could see the overall inflation kind of come down even further down, rather fast. So, yeah, it's at support now. Do you think it'll continue its pattern, or do you think oil will dump due to slowing economy and less demand? So, right now we're once again at support. If you simply take a look at the technicals here, every time it's come down to low 70s, it's gotten bought up. So we are seeing a lot of momentum at those prices. It really depends, every single time. I think the last 1, 2, 3, 4, 5, the last 5 times I can vaguely remember, 3 out of the last 5 times we've seen appropriate supply cuts at around those support at low 70s, right? Every time oil price starts to come down, we get announcements from Saudi Arabia, from OPEC countries that they are going to pull back on those supplies and they're going to start to cut production a little bit, and that pretty much boosts that demand, pushes prices back up. So again, we'll find out if this continues, if this pattern continues, but we are definitely out of support at the moment for crude oil, trading at roughly around $70. Food always lags, also energy and things like that. So food, yes, definitely something that needs to come down eventually. Groceries steadily climbing on holding higher prices, but definitely prices have not gone down, Kunal says. So thank you so much for mentioning that. And if that's the case, then I think food and shelter are going to be a little bit more stubborn than anything else. The sound is too low. Let me see if I can fix that. Is it better now? How is it better? Just want to make sure the audio is good. So give me a thumbs up if it's good. Since in the words of Chef Ramsay, not good enough. But yeah, the markets here, not a very significant reaction to it. We did drop and then we rallied back up, and that's exactly what we're seeing. The dollar index is coming down, and QQQs are up 1% right now. We got the SPY also pushing higher, up 1%. So a lot of individual stocks like Tesla, 2.6, and Microsoft here, 74 basis points. Google's up. We got Alphabet up 1.5%. Apple's up over 92 basis points, with Nvidia up over 2% as well. Let's take a look at some of the banks. XLF is pushing higher 3%, and FAS is up a little bit over 9.4. So very, very strong move for bank stocks, of course. Charles Schwab pushing up 12.89, and FCR is going to be your FRC is going to be a First Republic Bank, now up almost 60% pre-market at the moment. Perfect. Sounds good. A little bit more. Okay. Let's see. I don't want it to like be clipping. I don't want it to be like, super loud. So it's like not that great, but hopefully it gets better. Yeah. So, I think I also mentioned in my previous video that I just posted about an hour ago or so, that the markets didn't really rally on this big shift on interest rates. Right? Even though, you'd ideally think, right, if we're getting 125 basis points pivot towards the dovish side, you'd expect the market to be rallying on that, but we didn't, right? Of course, we got a systemic risk problem with the banking sector, but despite that, we didn't really get the markets to be pushing higher. And I think one of the guests on CNBC made a good point about the valuation for the market, which is exactly what's been discussed in my other video. So make sure that you do check that out, because we go over the actual fourth quarter 2022. Once the earnings are released, we go over the entire 2022 trailing 12-month price earnings multiple. and a forward price earnings multiple as well for the S&P. And bottom line is, I mean, the valuation is still a little on the high side. You can make a case, you can exclude FANG stocks, you can look at 2024 earnings, you can go even further out, 24, 36 months, but that's not going to change the fact that the multiple is still a little too rich. I think market's still underscoring the fact that there is a probability, or at least a recession still in the cards. So if that happens, that's directly going to affect earnings, which is directly going to affect the multiple, which is directly going to affect the S&P 500's index value. So those are some of the concerns that I have. If we were trading at a 15, 14 times earnings multiple, even though inflation was higher, I would have not had any problem with the market multiple at that point. I would have been a lot more interested in dollar cost averaging, but because of the fact that we've moved up so much so fast and the multiples expanded in a very short period of time, despite not having any resolution to the economic conditions, makes me a little bit concerned about where we are. Bring the red mic back. Oh man, that's gonna be brutal. I don't think so. People are just not gonna like that very much, Milan. Even though I'd love to, and we're gonna get some good deals if the red mic makes an appearance again. But I don't think people are gonna like that. So short at 393 SPY today, if you can get there, Hassan says. And right now, 65% people are expecting that the Federal Reserve is going to hike going into next week. And right now, 85%, according to the Fed Funds Futures, expected that the Federal Reserve is going to hike. We have not seen a change to no hike, which is a little bit of a good sign that the market's not anticipating a huge rally on this no hike pivot, dovish pivot, which makes the conditions a little bit more stable, because had we been rallying on this anticipation that we're going to see no hikes next week, we're only setting ourselves up for potential disappointment when the Federal Reserve comes out, Jerome Powell comes out, and pretty much gives us nothing, right? So I think it's a good thing that we are not rallying pretty hard on this really decent inflation report and not expecting no hikes from the Federal Reserve. Red Mike is dead. Yes, so we were at the funeral. Kevin, if you remember, we did a live stream during the funeral of the Red Mike. Yeah, today's volume for FRC is half already. Yep, so we're seeing a lot of momentum back up, no doubt. Coupons, ring out the Red Mike. I dare the markets to crash. No, I think, a far more reasonable level for the S&P, at least right now, given what I believe the earnings per share to be in 2023, is going to be at closer to, 3,500, I think. Because at that point, we'd be trading at around 15 times earnings. That's going to be in line with where we were back in October. Now, of course, a lot of things can change. That obviously depends on the no landing, soft landing, hard landing scenarios. But there is going to be an earnings recession after the first quarter. We already know. I also wrote that down in my other report going over the FactSet's expectations from analysts for the first quarter earnings. So crypto is flying. Let's take a look. So Ethereum, look at that, 3.3%. So lots of momentum. It looks like back risk on here. Bitcoin getting up to over 25,000. I feel like this is the first time we're seeing Bitcoin here at these levels after a super long time. And we got Bitcoin's not traded at 25,000 since June of last year. Look at that. Seeing a lot of momentum for Bitcoin here, almost getting up to 26K. Ethereum's on the move, so a lot of momentum back up for Ethereum as well. Ethereum's just getting up to its previous resistance, but Bitcoin definitely on the move here. Clean Spark pushing up pre-market a little bit over 7%. We got Marathon pushing up over 10% right now, back up to 740. Grayscale Bitcoin Trust up 5%, and Riot's up over 8.8% right now as well. So lots of momentum driving these moves higher. Yields rotating back up a little bit. We're seeing, again, a reallocation away from bonds over to equities, seems like, more specifically tech. So we're seeing bonds kind of yields push higher, prices come down, and equity prices also roll back higher at the moment. So, Caddy, has the contagion effect of Silicon Valley Bank fizzled out now? I believe it has. That's exactly one of the reasons why I wanted to put ETF XLF on your watch list, is because I believe there was an opportunity here, considering how oversold and overblown the fears were. And the only risk there is right now, so you can look at it in two different ways, right? You can look at it, how do the big banks benefit? And is there opportunity with the regional banks? Now, I do think that their reserve requirements from the Federal Reserve, because regional banks don't have any reserve requirements, right? I mean, a lot of the big banks, when you consider if you're doing $110 million or over in transaction volume, you've got to meet with the Federal Reserve's requirements of capital, right? And you're considered as a larger bank, right? You're considered as a pretty big institution. But a lot of the regional banks that are doing less than $110 million in transactional volume, they've got little to no reserve requirement. I think it's 3.5%, but then under 50 million, it's like nothing. So those regional banks might still be under pressure because even though the Federal Reserve, FDIC, and the Treasury Department have stepped in and they've backstopped all the deposits, and they've pretty much mentioned that, you know, all deposits are safe, it was all about restoring that confidence, right? Because the entire system is built on trust, as I mentioned in my previous live streams, right? If you lose that trust, everyone's going to be pulling money out, right? Because there's nothing left, right? Trust is the only thing that's keeping the system together as a currency, right? As fiat money, because it's not backed against anything. So if regional banks were not stabilized, they would have seen a significant amount of outflow from them, and then where would have that money gone to? Two places, right? As I mentioned, U.S. Treasuries, right? People can kind of hedge their deposits with U.S. Treasuries. They can kind of store, you know, you can even get as low as 4 weeks, 8 weeks, 13, 26 weeks. That's exactly what we're going to be building out in our T-bill ladder. So when we're doing our bond ladders to pretty much have that capital preservation, we're going to be looking at short-term Treasuries to build that ladder. So that's one place. And the other place is pretty much going after SIBs, right? Systemically important banks, and that's your big banks. That's exactly one of the reasons I went over XLF's holdings. And if you take a look at the holdings for XLF, it's large banks, right? JP Morgan, Bank of America. The reason why they're considered SIBs is because if they fall, that's it. I mean, that's a big crisis, right? They're considered, I mean, they can trigger a financial crisis, and that most certainly the government will step in to make sure that they don't go under, right? That's why they consider it too big to fail. So there's a couple different ways you can play this. You can look at XLF, which is already your SIBs and your top banks, and all the fear that's coming into these banks is a little bit overblown because yes, their bond portfolios are underwater. Yes, a lot of the lending activity and the investment activity that happened 3 years ago, a lot of their market value is going to be much below than where we're trading right now because of the lower yields, because it was a game for searching for yield, right? 3 years ago, when nothing was really paying you anything, interest rates were super low. Silicon Valley Bank had to really reach out for longer duration mortgage-backed securities to get that yield to make sense of their deposit base. Otherwise, they were just holding on to capital and losing it to inflation. So they had to do something with it. So even though these banks also do have or are in a very similar situation, their capital requirements are much higher, and at the same time, they're too big to fail, right? So XLF definitely represents that opportunity. Another one is KRE, but the reason why this is a little bit more volatile and more risky is because it's regional banks, right? Despite the fear and the contagion being stabilized, there's companies still out there that might consider, you know, why not just simply go after SIBs, right? Why keep the money in regional banks after everything that's happened, even though it's safe, even though it's fine, FDIC is insured, why still keep it there? You know, you can just pull that out and then move it to a different bank, SIB. So greed is back. Kevin is saying, so it looks like it, right? So we're definitely seeing a lot of risk on momentum here. But to answer your question, long answer short, yes, I do think it's stabilized at the moment. Not maybe not for regional banks, but definitely for SIBs. Let's go Bitcoin to 30,000. So Bitcoin is still Bitcoin. Yep, so moving higher quite a bit. Lots of momentum here. 26,000 now. Wow. It's definitely getting a lot of momentum. 7% green at the moment. 26,100 was the high for today. 28,800 is going to be that next level, and this is going to be a new support for BTC. So right now, this is going to be a support resistance all the way up to 28,800. So John says, value of banks, long-term bonds are still going down though as yields spike. Even if banks hold on now, it seems like it is only a matter of time before another bank to topple over to the Tesla system. That would be true, I would say, like for more regional banks. And the reason why I feel like, so a little bit of a pushback there. And the reason is because, number one, we're definitely on the higher side of the yields and how high they're going, right? The reason why MBS products and US Treasuries, the market value of these have dropped is because yields have gone up, right? So much. So if you simply take a look at the 2-year, right? I mean, this is just skyrocketed, right? I mean, this is just absolutely skyrocketed. So anybody who actually bought, let's say somebody bought the U.S. Treasuries 2-year T-bill back in September of 21, they don't mature until September of 23, right? It's a 2-year T-bill. But since they have actually had a 2,400% increase in yields, the market value for that bond is going to be dramatically lower than what they paid for it. So if they want to get out of that bond now, they're going to be taking on a huge loss. Like that would be like a complete bloodbath. But if they hold on until September of 23, they're going to get their principal back, right? So I do think that we are definitely at the higher side, higher end of the yields here. So the only reason we see bigger and more losses for banks is if yields keep pushing higher. If we see another round of spike here in the 10-year yield, the 2-year, 3-year, everything starts pushing up even more. And the reason why I don't believe that's going to be the case is because we are towards the tail end of interest rate hikes. The Federal Reserve, maybe we're going to see another hike, maybe another couple hikes, and we're towards the end of the interest rate hike cycle here. And then another thing was that I forgot I was thinking about in my head and while I was explaining. And yes, another thing is that when we talk about some of the larger banks, they've got the ability to hold till maturity because they've got the deposit base and they're meeting up with those capital requirements. This is more of a problem for any bank that's holding on to long duration assets, bonds or MBS products or treasuries, which are expiring in, longer term, but they don't have enough capital right now to meet the deposit requirements, right? And Silicon Valley Bank, the problem they had was all depositors needed their cash almost immediately, and they didn't have the capital to meet the deposit base. FAZ for the win. Isn't that like a inverse ETF? Yes, so Bear ETF. It's down 9.8%. Kevin, what are you trading over there? Share with us. What are you into? Are you buying puts here? Lon says, man, I wish I bought FAS yesterday. Yeah, I mean, it was a little bit oversold. On the downside, there was definitely a lot of fear. So, Brown Boy, I'll definitely see if I can do a marathon video very soon. Any reason why crypto is going up. So, we're seeing a lot of risk on environment. I think inflation's coming down. I think there's expectations that interest rates are going to once again flip back over. Let's see. Let's see what we are seeing for the Fed funds futures here. Wow, 91% probability. Market's disciplined today. I like it. I like the market's actually very disciplined right now. There's not a lot of mispricing, at least not in my view. That we're seeing a 91% probability. I mean, ideally on a day like today with inflation numbers coming in as they did and what we have going on in the macro backdrop, you'd easily be expecting no hikes from the Federal Reserve. But the fact that the market's still pricing in 25 basis points, this goes to show the market's a little bit more disciplined today than what we're used to seeing. So we're at JP Morgan, good swing trade now given the opportunity here. So I think so. I mean, their book value, price to book value is really low. And really, I mean, if you want to take advantage of that diverse exposure, definitely do research and due diligence on XLF. But I like JP Morgan and considering that, it is one of the SIBs and a lot of the deposit base is going to flock over to JP Morgan and the likes of Bank of America, Goldman Sachs. I think these are the companies that could benefit. And the thing is that they are getting a big influx. If we were to see a big outflow out of regional banks and over to these SIBs, what is the big benefit that these banks now have that they did not have 2 years ago? Let's see if anybody can answer this question. So the question is, now that we may see the regional banks, a lot of depositors kind of pull money out of regional banks and maybe kind of consolidate into big four. Again, we'll see if that happens. But if they were to move towards SIBs like JP Morgan and Bank of America and the likes, what is one big benefit of them having so much influx of cash now versus 2 years ago? What is one thing that's dramatically changed that they can now take advantage of with this big influx of cash or deposits that they're getting? Yeah, PPI is coming out tomorrow. High interest. Yes. So interest rates are high, right? So they can really take advantage of U.S. Treasuries. They can still find that really good spreads and kind of expand their net interest income, considering that yields are still pretty high compared to where they were 2 years ago. So there weren't as many higher investable opportunities for banks 2 years ago compared to where we are now. Yes, bonds bigger return. Exactly right. They can hold the short duration bonds. Exactly. 3 months, 6 months, paying you a pretty significant yield, and they don't have to pay anything on deposits, right? Deposits, they're paying you literally next to nothing. So their spreads are going to be, man, crazy. Yeah, Bank of America's up 7% pre-market. Wow. 6%, pretty substantial move. Like yesterday's sell-off in banks was a little interesting considering that the government had stepped in and backstopped all of it, you know? It was quite interesting. That's why I think it was important for us to disengage from what's fear-driven versus what is value-driven. And yesterday's move by far, I mean, especially for some of the SIBs, made no sense for Bank of America to be down 6% or JP Morgan to be down that much. They were protected, in my opinion, at least. So did someone say crypto? So yes, we were talking about it earlier. Crude oil prices once again in the low 70s here. Volatility trading just over 24, but down 8.6%. All yields are rotating back up a little bit, including the gilts. We've got the yield curve now down to negative 66 basis points, still down quite a bit. So they're down about 62%. In fact, they got up to as much as negative 37. Man, the yield curve almost turned positive after such a long time. Since July of last year, it almost, in one single day, it popped over 500%, I think. Yeah, 53%. 54% in one day. Yeah, Bitcoin looks really strong. 9% move here. 27,000. Well, 28.8 is going to be that next resistance for BTC. For all the crypto gang, 28,000 is going to be that next level. Marathon's up a little bit over 14% now, so seeing a lot of momentum, 765. We got a resistance sitting at 923. That's going to be that level to watch for Mara. And then Riot, resistance sitting all the way, I would say, up to as much as 760s. This is a pretty strong resistance for Riot. All right, so what do we got? We'll probably have Jim Cramer talking about something. Does anybody want to listen to him? I can play him right now. We can listen to what he has to say a little bit, maybe. Let me know in the comments. Yes, make sure that you drop a like, everybody. Make sure that you drop a like. I would really appreciate it, David. Thanks for reminding everybody. Yes, Sanjeev, that's right. They will be able to get bonds at a higher rate. So we do still have the poll open right now. I'll close it in about 5-10 minutes. So make sure that you vote. What do you think the Federal Reserve will do next? Are we going to hike rates or... No, and then yes. Let's hear him. Let's just go ahead and hear him. All right, for once. Let's just see what he has to say. Come on.
That's what this is about. This is not about do they have enough money in terms of the equity. Do the banks have enough equity? This is confidence. Do they have enough deposits? And it is absolutely true that it's so easy to journal deposits to JP Morgan that you have to understand, Bank of America, that's what this is about. This is not about do they have enough money in terms of equity. It's do they have enough deposits. I mean, for instance, let's take Huntington Bank shares. Like Huntington Bank shares, very good bank. Did not see any outflows Thursday. Did not see any outflows Friday. Written reports about how much insured have suggested that they don't have enough insured. Actually, they have the most insured of any region. So when you look at Huntington Bank and you see it yields, 6%, you say that's a bargain. And I do think it's worth buying. But at the same time, if we find out there's a failed auction, remember, FDIC, they're not really that good at doing auctions, and JP Morgan's the one that would be a buyer, but they're not allowed to because of our doctrine. Then I think you buy H-band, you want to hold it, but someone's going to come with another wave of selling when it comes over the tape. If it does, no buyers for Silicon Valley Bank.
Well, there aren't any as of yet.
No, they're not.
We are seeing a nice bounce, as you see in all those regionals. There was a lot of concern, I think, yesterday. Comerica stock price, KeyCorp. These are very important banks in their communities.
But Citi actually has a much better deposit base than people realize. They do a lot of cash management.
Yes.
Schwab is a much better.
But it's not, you know,
because
what
they do a lot of.
But what
cash
you
management.
also have right now is a lot of people looking at the held to maturity portfolio of a lot of these banks. And by the way, across the board, what has been the impact of this rapid rate rise in rates over the last year?
Right.
And have we really taken account for it? That, of course, we saw with Silicon Valley Bank in terms of both their available for sale portfolio of bonds and also their held to maturity. But now, guys, you have a lot of people analyzing the held to maturity portfolios, even at the biggest banks, and saying, what would the markdown, what is the proper write down? It doesn't really matter as long as deposits don't flow out. And as we know, for the biggest banks, they're flowing in, not out.
They're taking in billions.
Yeah.
Meantime,
they are.
You got the Fed initiating this internal review of their supervision, and we'll get results in May. You've got Ackman versus Griffin now. Griffin and the FT saying this used to be a capitalist economy breaking down before our eyes.
You know, we're an economy that Hamilton did not want concentration of banks. So we used to be we're trying to stay true to Hamilton, not trying to stay true to Marx and Engels. And it's important you recognize that we uniquely have supported small and medium-sized business. And I don't know what he wants to do, but if you want to make it so that that's no longer the doctrine, the Hamilton doctrine, then that's absolutely fine. It's not what I want. I mean, I had Colin Frost on last night, okay? Colin Frost has, and you'll like this, David, they almost nothing hold maturity because they always thought that was pretty reckless to do. They go very short, and they have sticky deposits. And that's why the CEO bought $1 million worth of stock yesterday.
Ken Griffin says losses to depositors would have been immaterial.
All right, I think that's enough Kramer for one day. But yeah, I mean, we'll see if the markets actually start to pull back. And right now, we're definitely seeing a pretty significant gap up here for QQQs, up over 1%, of course. The dollar index kind of rotating back higher slightly. Since 9 a.m., we were seeing a little bit of a move back up in the dollars. So again, markets are already gapping up here. It's going to be interesting how much momentum we see intraday. Would not be surprised if we do see a little bit of a pullback, start to see a gap fill, and then some momentum drive the markets back up maybe. But Tesla here, 2%. Google here, 1.5%. And we got Apple pushing higher as well. So I'm going to end the poll now, 64%. So 2/3 of you expecting the Federal Reserve to hike rates going into next week, and 36% expecting a pause. And now we're going to do our regular markets open poll. Market today, green, red, and then flat. Let me know what you all think here. Let's see if the expectations have changed. And again, 8 days till the next FOMC meeting. So March 22nd. Man, I'm actually proud of the markets today, honestly. This is a disciplined market despite the good inflation expectation. Not necessarily good, but kind of meeting expectations. And, considering core coming down to 5.5, I would have expected the markets to pivot it to literally no hike, but markets are disciplined today. We're still expecting 25 basis points. That's a sign in the right direction. School Bank of America, good one for the long term here. So both Bank of America and JP Morgan, I'm going to be interested to find out what their deposit base has grown to in the upcoming quarters when they report earnings. So the next earnings are going to be coming up on April 18th for Bank of America, and this is going to include up until March. So I think it's going to give us a little bit more indication of what their deposit base grew to, right, during that first quarter, which is what we're going through right now. And JP Morgan is going to be in that similar situation. So from a technical standpoint, yes, I think both of them are incredibly oversold and valuations have come down. Yields have pushed up for them, like JP Morgan 3.05%. We got Bank of America giving you now over 3% as well. But really interested to find out because, the effects of this are not going to be seen right away, but instead 3 to 4 quarters from now, because the influx of demand deposits they see, they're going to reinvest it back into maybe treasuries to keep that, deposit base pretty liquid. And those are going to convert into earnings because their net interest margins are going to be pretty significant considering how high yields are at the moment. So I think the next earnings report for banks are going to be very important for regional banks and for institutional banks, bigger banks. I think the next earnings season, especially for the financial sector, very, very important. It's going to give us a lot more insight as to where the money flew out of and where it actually went. liquidity wise. So yeah, that's where we are. 15 minutes left for the markets to open. Now I'm going to open it up for everybody. We've covered pretty much a lot of things from the macro standpoint, valuation, inflation, interest rates. I think we've covered all of it. I'm going to open it up for the next 10 minutes, 15 minutes for any stocks that you want me to go over. Happy to go over that for you, kind of share my thoughts, share the analysis, fundamental, technical analysis very quickly. Spend a couple minutes on your favorite companies and your stocks, and then we're going to prepare for market open here. So, have you nibbled into Microsoft yet? It has bounced from the 50 SMA perfectly last 6 weeks. So, I have not, David. I think 250 is still a bit too rich for me, man. Like, I really want to, but I feel like 250s is still a bit too high. Like, I would be all over it in the 220s. That's where I feel like the nice coupons are going to come across for Microsoft, but 250s is still too high for me. NTCH. So, I feel like that's going to be Match Group. So, selling off pretty, wow. That's quite a bit of a downtrend here for Match. 180 down to 35, so down 80%. Wow, so they've had a pretty good uptrend here since 2016. They've gone up over 1,500%. So technically speaking, next support is going to be down here at this level. It's going to be sitting roughly at $34 to $35. Seems to be a good profitable company, but let's take a look. So 29, 30 times earnings. So take a look at where we're coming from. Just in the second quarter 22, it was 219 times earnings and down to 149, down to 34, and now we're under 30. Now we're under 30 after an 80% decline. And even 30 still seems a bit of a higher multiple. 19 times cash flow, 14 times enterprise value to EBITDA. So it's not terrible, but definitely a little bit on the high end for the valuation multiples. And then if you take a look at the share count here, pretty stable, so that's good. And then we've got, let's take a look. Balance sheet, they're sitting on $3.3 billion of debt, so they got a pretty substantial amount of debt. And then earnings expectations are expected to grow from $2.05 to as much as almost $4 in about 4 to 5 years. That's a pretty good growth rate expected for Match. So if you do any type of analysis here, intrinsic value. But no, that's a good 100% growth here. So I'm gonna assume about 25% CAGR there for the company, and they're trading at about 29 times multiple, which is actually not bad. So if they're able to grow their earnings at 25% compounded annual growth rate, this is a good support level at around $34, $35 to consider a Match at these prices. But again, I don't know much about the company. I don't know what they do. Okay, so they're in the dating products worldwide. So kind of like, also brands include Tinder, Match, Meetic, OkCupid, Hinge, Pairs, and then there's like a lot of them. But yeah, I think $35 is going to be decent support level to watch from a technical standpoint. Valuation's kind of reasonable at those levels. All right, so let's take a look at Apple. So again, the companies that I go over on a more regular basis in our market updates, I'm going to skip over because, you know, we talk about them all the time. I want to go over companies that we haven't really gone over. So Milan Tesla, for example, I'm going to skip over, unfortunately, because we do go over that a lot, right? We talk about it pretty much all the time. But I want to give a chance to some of the other companies that we don't really necessarily cover on a regular basis. So SQM for Sutta, let's take a look. No idea what this company does. 19-20 billion, 7% yield. That's pretty good. So fertilizers, potassium nitrate. So it seems a little bit in the agriculture sector. So we have revenue, which is very stable, pretty decent. Net income at $558 million, 20% margin. Let's take a look. So really low multiples here. And consistent share count, not bad. So let's take a look at their balance sheet. And they're sitting on negative net debt. That's a pretty good company. So we've got share dilution with non-existent, pretty stable share count. Earnings multiple, that's really, really low, trading at 7 times earnings, and I think even lower price to cash flow, 6.75, and enterprise value to EBITDA at 4 times. Price to book at under 5, and we got negative net debt, meaning that companies got more cash than debt on the balance sheet. Earnings are expected to, look at that. I knew something was wrong. It's too good to be true. So this one expected to decline in earnings over the next 5 years. 1329 to 1074 to 809, and then 772. So for the next 4 years, 5 years, both sales and earnings are expected to decline for this company. That's quite interesting. It seems like it actually had a pretty big spike in 2022 and then come down over the next several years out. But it kind of feels more like a Zim integrated shipping very much, but they do have a pretty good yield at 7%. Okay, largest lithium mining, so miner, okay. Correction. So 2950 level for XLF. Let's take a quick look. Yeah, so 2950, still watching that, but I do feel that it's, maybe it's not going to get down to those levels. But yeah, that's the support level that I'm paying attention to right now. Srinath's Meta to lay off 10,000 people and close 5,000 jobs as well. Wow. Let's see how Meta's reacting to that. What, 2.4%? This came out about a few minutes ago, so cut roughly 10,000 jobs covering over the coming months and second major round of major layoffs. So we were expecting that, right? I did a video about this, I think last week or the week before that, where there were some news reports that they were going to do layoffs. Another round of layoffs. So really, really cost-cutting measures here for Meta. All right, so let's take a look at Walgreens. So Walgreens, Tina, obviously it's been under a lot of pressure. It's been selling off quite a bit. I mean, as soon as it got up to a resistance of 42.50, just started rolling over pretty aggressively and then started selling off even more. And then right now we've got a dividend yield sitting at 5.7%. This has always been a more of a longer term dividend stock for me. So, been collecting about 5 to 6%. Yield on cost, which I think is a more important metric because it takes into account what is your yield with respect to the cost basis you have on that stock, not necessarily what you see over here, but at what price you actually bought it versus what the yield is. So $30 is going to be that support. That's the level that I'm watching. Maybe we'll add more to the dividend stock here, but I'm happy with my position right now. So we'll see, but definitely a resistance at 41, 42. And, a couple times we got validated at that level. And then right now we're just getting that all resistance act as a bit of a resistance right now. All support acting as a bit of resistance. All right, let's see. Disney, we can take a look at as well. So Disney, we got a pretty strong support at 79. That's going to be the level. So that's also the pandemic low. March 2020, we got down to that level. A couple times we validated that level as well. So very strong support here inside this green rectangle. In fact, we were at that level on December 27. We saw a very strong rally, 35%. So right now, it's also not able to break out of these resistances. So a little bit of a rejection there for Disney at those levels. All right. So Edward, any stock I fancy going long before market open? Again, that's more of a market timing question. We do look at specific swing trading ideas. We do look at options trading ideas. But just, right off the bat, like a stock to go long in over the next 9 minutes, it's kind of difficult to kind of go over the risk reward parameters, the trade setups, and, which ones I like or don't like. So I'm happy to kind of evaluate if you have any trades in mind for you. But I'm definitely paying attention to XLF and FAS. FAS, I've got a potential options planned out, but the 11% move to the upside is definitely going to wreck the premium out, because I had a cash secured put planned out for today, but pushing up 11.3%. The return on collateral is going to drop as the premiums come down for CSPs. Call premiums are going to be definitely higher because it's going to gap up pretty aggressively here, but I will reevaluate and see. So David, thank you so much for sharing your morning coffee with me. I appreciate it. I hope you have a great day too, and we'll touch base once again later. Love the new graphics, Ian. Thank you so much. I appreciate that. And let's take a quick look on where Bitcoin is. 26,000, so still moving up. Very nice green day. Ethereum's up over 4%. Not really seeing as much momentum as Bitcoin, but still pushing higher quite a bit. And we got the NASDAQ 1%, QQQs, and a lot of momentum. So stock biggest holding, I believe it has to be Tesla. It's grown to be one of the bigger positions for me. And I don't think I need to go over the why, because Tesla, come on. Tesla is what Tesla does best. And that's why I had the covered calls, right? Because I was more than okay to kind of get rid of some of the shares that would have allowed me to trim my position a little bit. But we'll definitely be looking into buying more the lower it gets. So 120s, 130s is my fair value. Love to pick up more shares for Tesla around those levels. So IGO, an Australian exchange stock. Have you had the chance to look at Aussie shares? It's funny you ask. I actually had a project in school where we analyzed NAB, National Australia Bank, which was traded on the Australian Stock Exchange. We had a complete report on NAB with me and my other partner in the project, and we did a whole analysis on this. And yes, I am familiar with the Australian Stock Exchange, but no, I have not looked at IGO Limited. And in the future, the plan would be to kind of dive into some of the other markets as well, maybe some European markets. We've already started talking about Indian markets because I do believe there is opportunity, and Indian markets are also kind of IND is rolling over a little bit, selling off, in conjunction with what we're seeing with the markets over in the US, but we're seeing a little bit more momentum to the downside for Indian stocks as well, which only represents buying opportunity. And I will be kind of adding more shares in April for some Indian stocks. So again, we'll be diving into some of the other markets as well. FRC, bouncing back. Yep, so we talked about it earlier. It's getting a huge bounce, 51%. But we got 5 minutes for the markets to open, so we're going to switch over to the NASDAQ here, S&P back over here, the Dow, and the 10-year yields also on the move right now, pushing up 81 basis points. Marty, I feel like I've got so many names now. I feel like I've got Caddy, I've got Scotty, I've got Marty. Marty's a new one. That's funny. Yes, I'm turning up the volume on my mic here a little bit. So, Edward, thanks, Caddy. I've been listening intensely to you yesterday about XLF and FAS. More good coverage, totally helpful. Yes, so we're seeing a lot of momentum in financial stocks here. I think that momentum could continue. You should come up with new names. I need new names now. No, come on, dude. Not Kathy. Don't completely change my gender for my name. Just keep it consistent. Just a different name. That's all I'm asking. I like Marty. I also like Marty. What was the name of that guy? Wasn't it Marty in Ozark? It was just like this really, really balanced, cool, composed. Ozark's pretty good. If anybody's interested in a new series, thriller. It was fun to watch, and I think his name was Marty, right? It's been a long time since I've seen it, but. So, Danny, do you have a retirement account? So I used to, when I was in the US, I used to have a Roth IRA and then 401ks, but since I've moved back, I don't. The problem is, limits over here in India. I do have a retirement account, so to speak, but the limits are so low. It's not even worth investing in, but I still do. But it's really just, oh my God. This conversation is just getting a little too out of hand. Yeah, Ozark was good, yep. But anyway, so we got 3 minutes left for the markets to open here. So VOO, Vanguard ETF. Really, there's a couple questions you need to ask yourself if you're just investing for the long term in the S&P 500 with no focus or no attention paid to the macros, which I think is an okay thing, like you can dollar cost average consistently, then really you're going to focus on the periodic frequency of when you dollar cost average, right? Whether it's weekly, monthly, daily, you decide that, and then you just kind of buy regardless of what happens in the background. But if you are looking for more valuation analysis, if you're looking at, okay, where can I tactically approach the S&P 500, the market, in a way that I'm getting a better deal, right? I'm getting the best deal. So if I were to simply map out this right here as the line, right, for the market, you can kind of consider this as the average line, right? This is a very simple linear line that's moving higher. And this can also be representative of the earnings for the S&P 500, right? How the earnings have grown over time for S&P 500 companies on aggregate. So then you can kind of, make an assumption that, okay, every time the markets are above this level, they're considered overvalued. Every time they're under that level, they're considered undervalued. Again, I'm just doing this for illustration purposes, not saying the markets are below this, so they're undervalued. That line that I just drew is like literally not in context to what we have right now, but just for illustration purposes. So again, you kind of get a good idea of, how the markets can trade, because they will be overvalued and they will be undervalued, right? Very rarely you'll find the markets fairly valued, because they trade a lot on expectations, on sentiment, and what's going on in the economy. So our goal is to kind of identify opportunities where there's mispricing, when the markets are undervalued, and then when there's overvalued conditions, so we can kind of trim back a little bit, pull back on some of those. Cappy. God. Yeah, Marty is the main character in Ozarks. I hope they do another season. No, I think it's over, right? I thought it was over last time I checked. That Marty cleans bad money, yes. It's a lot about laundering, so that's not the best example that I want to use. Anyway, so 30 seconds left. Right now, 62%, or no, 72%. People are expecting the markets to be green, 17% red, and we got 11% flat here. Marty McFly. So yeah, a little bit of a bullish bias going into today. We'll see what happens intraday if you see some momentum downward. Definitely keeping a close eye on XLF and FAS, and most of the banking stocks. We'll see if they rally back higher or not. I'm actually going to split this up a little bit. We're going to keep XLF here. Going to keep FAS over here. And then we're going to keep, let's see, KRE and DPST, some of the more leveraged ETFs. All right, off we go. The market is open for business. The market is open. And we've got the NASDAQ here, gapping up pretty heavily, 1.5% green. S&P with a massive green candle coming in 1.3%. And the Dow is up over 1% as well. A lot of individual stocks here. Tesla pushing up 2.4. Today might be a good day for some covered calls on Tesla again. We'll see what the premiums look like. Let's see, calls and getting up a little bit, at least about a month out, April 14th. What are we working with? So not bad. 200 is giving you 450. 205 is going to be 350. Still a little bit lower. I'll wait for a few more candles to come in, see if you get some more momentum back higher. If you can get up to 185, then I'll be interested in maybe selling some covered calls on Tesla once again. So lots of momentum driving individual stocks to the upside. We got XLF up 3.7%. We got FAS still up 10.3% right now, 61.30. A little bit of momentum back down intraday, getting a red candle here. Then we've got a DPSD up, wow, 29% for this one. This is such FOMO. This is crazy. This is more on the leverage side, right? So 3 times leverage. So since this one's up like 10%, this one's up like 30%. And man, oh man. Seen so much momentum for that. Meta 5%. Oof. Pretty substantial momentum for Meta. So big tech, AMD's up 3.7, $85. We got Meta 4.3, Tesla's up 3.3, Nvidia 2.6, Google, Microsoft, Amazon, Apple, Netflix, everything just charging higher. So the only stocks that are down is UVXY, that's down 10%. It's more of a volatility play that's rolling over. Let's see if expectations changed here. Better not get, okay, good. 82% still expecting for the Fed funds rate to be hiked by 25 basis points, which is good. Discipline is key in this market. We can't just be rallying on expectations after expectations that the Fed's going to pivot. First Republic Bank, 57%. WAL, Western Alliance, 52%. Ally Bank, 11%. Man, look at these bank stocks go. They're like flying right now. Right off the gates. KRE, 11%. Oof. Momentum. Regional banks momentum's coming back in. Yeah, so Nugan, CPI numbers are out. Yeah, we came in right in line with the expectations, came in at around 6% year over year, 0.4% for month over month. Core was the only thing month over month that came in a little bit higher than what the expectations were at 0.5%. And year over year, we're still sitting at 5.5. So volatility down 11% now. Pretty significant sell-off. Since Tesla is up to 180 now, let's take a look. April 21st, let's take a look at those ones. Yeah, these are not updated for sure because, or maybe they are. It's updating here. Yeah, these premiums are not showing up, so we'll have to wait. But yeah, Tesla gets up to 185, and I am going to be looking at some covered calls again for this stock. Maybe not up to as much as 250 as last time. Might go a little bit lower. And then with FAS, if it can keep coming lower, maybe the cash could put still on for that. Spencer, I made some nice money on WAL yesterday. That's great, man. Congratulations. Glad to hear that. Open and Redfin are also on a roll. Let's take a look. Open Door here is up 9%. Pretty strong move. And then Redfin is up a little bit over 4%. So the heat map is going to absolutely be a green grass. That's what it's going to look like. It's going to look like turf, you know, like a football turf, all green. Considering banks are green, energy is going to maybe not so green, but still green. Then we got cryptos, of course, having a day in the sun. We've got cybersecurity, mostly green. Okta's leading the way there. Fintech, all green. We've got Ally Bank leading the way with Upstart, 3.7. We got Visa, PayPal moving higher. Then we've got, let's see, retailers. How are they doing? Staples, because there's usually a shift. If tech's going higher, there's a big shift. Usually that does happen out of Staples, but they're also pushing higher, except for Kroger and Dollar General kind of flat. And semis, killing it with AMD leading the way with ON Semiconductors and NVIDIA, all pushing higher. REITs, green. Non-energy, all green. Streaming businesses, all pushing higher. Pretty fruitful day for the market, right? So lots of momentum. VFC, Sonima, I do like that one. Also, it's a Vanguard ETF. So again, rest assured, or no, it's a different company. I'm thinking of something else. I apologize. So VF Corporation, I haven't looked into this company before, but 8 billion market cap, 5.7% yield. Looks like it's got some decent revenues and earnings. Produces, procures, and markets, distributes lifestyle apparel, footwear, and related products. Okay, so it's like an apparel retailer. But look at that drop. Consistent sell-off from $82 down to $21, 75%. And, you know, as the prices come down, yields have picked up. Right now, it's a potentially high-yielding stock, 5.7%, but man, the technicals are really weak for this stock. And if you take a look at the valuation, 20 times earnings, a little bit less than one-time sales, kind of appropriate for the retailer, 8 times enterprise value to EBITDA. And then if you take a look at the balance sheet, $7 billion worth of debt. No, thank you. and the share count has actually gone down. So they're good on the share count, good on the valuation. Debt is something to pay attention to. And then when it comes to the forecast, expect to decline quite a bit. And they're not expected to come up to the same earnings, not even the same earnings, until 2026, I believe, because they're expected to increase, but after a huge decline and then grow once again. And revenue is expected to stay flat. So wouldn't consider this as a growth stock. Definitely a bit of a dividend stock if that's interesting for somebody, but the momentum is really, really aggressive on the downside. So may have to look into this more to see what ended up happening. So let's take a look at the heat map here. Right now it's not updated, but we'll wait. Everything's going to be super green as soon as the market's open. So NASDAQ here, 1.75%. Some of the banks, let's take a look. FS is really pulling back. So we'll take a look at that cash is good put after all. And we got KRE also dropping a little bit. So banks still gapped up, however, pulling back a little bit on the day, and Tesla got up to as much as 182. And Google here charging higher. We got Apple charging higher. Meta's up over 5.7. AMD's up over 4%. So yeah, Tesla 182. I'm looking for the options chain, which is not loading up for me. So hopefully this thing loads up eventually so I can take a look at some of the premiums. So us in the rally, I feel like is mostly driven by the idea that the Federal Reserve is really going to start taking a more dovish stance, considering that they are somewhat breaking the economy, right, with the Silicon Valley Bank fallout, and inflation print coming in a little bit on the better side. And it's kind of like meeting expectations, meeting the consensus was optimistic to begin with, right? So we're kind of seeing that play out with the markets kind of more optimistic about the inflation print. And then obviously with the still disciplined though, not fully expecting no hike, but definitely considering that the Federal Reserve is going to take a more dovish stance starting next week, considering everything that's going on. So thank you so much everyone for being here. I've been here for over, I think, an hour and a half for a very long time, kind of breaking down the inflation report. But thank you so much for being here. I really appreciate all of you. Make sure that you drop a like and of course subscribe to the channel. If you're just joining us for the first time, simply tap that subscribe button. It's very, very close to you or your computer or your phone. And we talk a lot about fundamental analysis, technicals, macros, and a lot of other strategies and asset allocation as well. So I have actually posted a video 7 hours ago where we will be starting our real strategy and our bond ladders in April, May, and June over the coming months here, as we take advantage of higher yields and also take advantage of the market volatility that we're seeing month over month. So again, all the links down below. We'll love to have you on board for our Discord, and let me know if you have any questions. Reach out to me, and I'm always available. Happy investing. I will see you all in the next